Good day, everyone. I would like to welcome you to today's webinar with Nir Vulkan. Today's webinar is on AI, artificial intelligence in finance, present and future. Before Nir starts, I would like to give him a quick introduction just to share some background with you before we start today's session. So Nir is an associate professor of business economics at the school and at the Oxford Mann Institute. He's a leading authority on e-commerce, market design, financial technology, algorithmic trading, and hedge funds. Nir also leads 3 programs in our online executive education portfolio at the school. So he's director of our Algorithmic Trading program, with significant input from our Mann Institute, as well as our very successful financial technology and blockchain strategy programs. Nir is also the chair of the committee set up to advise the European Commission on AI in banking and finance. And finally, he contributes to our artificial intelligence program, specifically on AI in finance. So I would like to hand over to Nir to start today's webinar. Thank you.
Thank you very much, Brad, and hello everyone. And you can hopefully see me here with this amazing background behind me. No, it isn't. Never mind, we can pretend. But welcome and thank you everyone for joining in this very strange times when life is hopefully beginning to come back to normality. I'm delighted to be here today and to speak to you about this area. And as Brad said, this is something I've been doing and thinking about for some time now. And as I said, delighted to be here. My biggest concern with setting this up when I prepared my presentation is there's so much to talk about. So what I'm going to try and do is kind of give you a flavor of some of the issues that are happening now. But before that, let me begin by trying to change the slides here. That doesn't seem to work. So give me a second. There you go. So just really briefly mention, as Brad kindly said, that I am involved with a number of the online programs that we run at the Saïd Business School in Oxford. And the one most relevant to what I'm going to talk about today is obviously the program in Algorithmic Trading. That's a 6 weeks program that runs, the next start is in October and then in January and again. And you can find out more information about this program on our website. And the other 3 programs that I'm involved with, so I'm the director of the FinTech program and the one on blockchain strategy. I'm not that involved in the AI program. There's just a small clip of me in it, but it's a great program as well. So I would recommend any of you who are interested in this time and in learning more to do these programs. I think they're really good. And certainly I enjoyed making them. Okay, so what I take about today is in the limited amount of time that I have today, I'm going to basically give you examples of some of the things that are happening in finance now. And I'll start with general finance, and then I'm going to focus on algorithmic trading because it's an area I know very well, and it's an area that I think is very relevant. But the first thing is to say is that, of course, pretty much any decision about anything in finance now is made by algorithms or robots, if you like. It's just how it is. And you know, when we hear about AI taking over finance or computer taking over science, it's absolutely true. And that's not necessarily a bad thing, but there's a specific issues and problems that come with that. And I'm hoping to give you a couple of examples of this. So this by no means is going to be a comprehensive presentation of every different aspects of AI in finance, because that will take us certainly more than an hour to do, but I am hoping to give you a flavor of some of the issues that come from that. And then I'm going to look at more details at algorithmic trading. As I said, algorithmic trading is an area, to some extent, it's a good place to look at because this is an area that's been going on since the 80s. So when we talk about robots making financial decisions, that's been happening already in finance in the area of algorithmic or systematic trading for 40 years. And so there's a lot we can learn from that as well. And I'll mention some of the issues there. And then at the end, if I have time, and I always say it and I never have time, is I will talk a little bit about what's been happening with algorithmic trading and also with robo-advisor, which is, if you like, algorithmic trader for the masses in recent times, and especially since the pandemic starts. So it's quite an ambitious program for 35 minutes, but I'll do my best. And what I'm doing, I'm going to drink some water and then I'll start. So I've started by giving you some example of where computers or algorithms are making decisions about people, about financial decisions, and maybe a good place to start is credit. And the decisions on credit are largely made now by computers. As they should be, because there is an enormous amount of information available now that we could use, and there is fast computing in order to process this information and to make decisions about who to give money to, which is kind of what banks do, a big part of what they do. For example, if we think of individuals, giving money to individuals, we think the bank is trying to predict the likelihood of the people paying back. And this is kind of the asymmetry of information, the general problem with banking, where the bank doesn't really know much about whether I am going to pay back. I know better than the bank whether I can pay back. But now we have a new thing. This is my mobile phone. And my mobile phone knows better than me if I'm going to pay back or not. And why does the phone knows that? Is because the phone collects all kinds of information about me that can be used to deduce deep information about what kind of person I am. And actually that deep information is very useful in order to predict, will I pay back or not? So for example, you may have, I suspect many of you have heard of these, the personality stuff that started with the Facebook and the scandal that came with Cambridge Analytica around it. But by the by, we've learned that Facebook likes, which used to be publicly available, predict what we call the personality or the social personality or the big five, maybe you've heard of that, of the people with high accuracy. And I think what Cambridge Analytica said is it's sufficient with 3 or 4 likes to predict with very high accuracy main personality traits of the person. And why is that relevant? Because, for example, one of those personality traits is what we call conscientiousness. So we all have a score on conscientiousness, and apparently people with who are conscientious pay back their loans. Okay, so that's pretty strong evidence of that, and that is a strong characteristic of the person. So it makes sense for people to try and deduce that. And if you have algorithms that are able to look at the data that you generate, the digital footprint, the data you generate, you can use that to make decisions. And this is just the beginning. The really sophisticated stuff that's beginning to come out now is also using your movement information as well. So they built not just a static picture, which is what your personality is, but a dynamic picture of how you change and what you've been doing. And are you traveling more or less? Are you all kind of things like that? I have seen startups, actually for some reason also in Cambridge, that were looking at your mobile phone data and deduce from that the likelihood that you're being depressed or your mood in general. And you can see that all these things with enough training can be really, really useful prediction of you, and therefore on the likelihood that you will pay back, which is really what providers of credit wants to know. So this is on the individual level. If we look at SMEs, at small businesses, you can also now use information. So in the olden days, the banks will just look at your credit history and maybe your financial in order to make that decision. But now you have, you can collect information, for example, about the consumer feedback they give on you on social media. Yes, so you can buy now that kind of information in real time. So you can collect information about the credit, about the consumer reviews that they give your business. You can also buy, I mean, this is amazing stuff. You can buy information from satellite image and drones about the state of the offices and how many people come in and come out, and use that as a prediction of how well the company is doing, and use all that kind of information in order to make decisions. So you can see, and by the way, I'm not saying this is good or bad at this point. I'm just saying that there's enormous amount of information that is really relevant to the decision that we need to make. And that information is now, you can get it from digital footprint, and you can analyze it because you now have very fast computers that are able to use this kind of information and make decisions very, very quickly. So this is one example. Another example, and this is not my slide, this is based from I think MasterCard. This is what we call anti-money laundering and know your customer, so AML and KYC. And the issue with that is also what we call the false positive, and we all had that kind of annoying experience where we're in holiday somewhere we haven't been before, and we use our credit card and it's being stopped. And then we start ringing and texting and getting hysterical, and they're saying, well, you know, you never used that credit card there before, we thought it might be stolen, and all that kind of stuff that's happening. And this is again an area where computers might much be better, and the numbers here, as I said, from MasterCard are pretty clever at saying that you can reduce significantly all the bad decisions, if you like, around anti-money and around know your customers like that. Okay, so just to be clear, the reason that the companies are bad is because they can't afford the other kind of mistakes. They can't, you know, let your credit card be used by bad people. So what they do is they make a lot of mistakes on the other side, what we call the false positive. So AI can be used and is being used to significantly reduce the false positive, using all these things we just talked about, all this kind of information that's available now, and that we can use the data to analyze, and we can use fast computers to analyze it. So these are just two examples out of many, 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 and hopefully it gives you a flavor of the kind of things that are happening now. Now, with all these wonderful things come new kind of problems. And I can't, sorry, because it's all in the news now, I can't stop thinking about Little Britain. It's obviously in the news because I don't know if you've seen it today, that they withdraw it from iPlayer and Netflix, because obviously a lot of these things that they used to do would now be seen as racist. Anyway, that's by the by. But if you remember, there's one character who works in I think in a bank, and it's a guy playing a woman sitting on the computer, and basically the famous catchline is, computer says no. So you come, you ask for, computer says no. And actually it's kind of a really coarse sketch, but if you like, it is the core of the problem with AI, because, you know, who is responsible now for these decisions? Is it the algorithms? Is it the people behind the algorithms? What if the algorithms are adaptive, as we will say, learning algorithms? They learn from data. The person who designed them doesn't even know what's going on in them. It's a 10-layer neural network thing. You don't even know what it means, what the layers don't have meanings. It's all been adapted. Do you know who do we take as responsible for that? So there's big issues that coming around that. The example of discrimination is a good one because, for example, in the US, you're not allowed to base your credit decisions or any financial decisions based on the area code, so where people live. It's different in the UK. In the UK, it's allowed. But in America, you're not allowed to do that. But what happened is that when you give the algorithms all this digital data and so on, that's what they learn. They don't even know that's this, but effectively that's what they learn. So they learn to do something that actually is illegal. Discriminate in that case based on that. Now it gets worse because we know that you may have seen the story around the Apple Card, the new Apple Card that they've launched with Goldman, and that there has been some stories, it's in the press, that you can look it up, that they say that there was a sort of a husband and wife that applied, and the husband got a bigger credit than the wife. And so they're saying there's some gender discrimination and perhaps also discrimination of race and all these things, because that's what the algorithms have learned in the past. So that clearly is something we do not desire and that we in fact legislate against. But you know, if we are allowing this big sophisticated machine to learn things that we can't even explain how, we have to be prepared for these things and to have regulation in place that has, as I said, accountability around that. So as I said, so there's a number of things. There's what we call human in the loop, turn off buttons. We're using actually, interestingly, a lot of terms now in finance that come from aviation when they have autopilots, or also now in the cars, the self-driving cars. You know, basically there must be the opportunity to turn off of these things. And I mention aviation because this is, if you know, with the 737 MAX, you could say that that was the first example where AI killed people, because if you remember, there was a special mechanism for changing the nose, and the pilots were not able to turn it off. And in that case, it's misfunction, or it functioned in the wrong set of circumstances, and it brought down the plane. So we have to kind of think about these things in a clear way. And whole term, as I said, an interesting form of regulation comes around that. I'm involved in that with my work with the EU. Lots of people are thinking about it all over the world. And we're even having new words like explainability. I don't think that was a word before around that, so that you can require that that there is a you know, a way that the people that are responsible for the algorithms are also responsible to explain it in a way that's sort of with what we call reasonably possible to understand. And if we don't, then that's not acceptable. So this is some of the issues that are coming. As I said, it's just a couple of examples, but hopefully give you flavors. And let me go a little bit deeper, talk about Wonga and Funding Circle, just to illustrate it more. So Wonga, who is gone now, but you may remember, it was giving what some people call payday loans, so lending small amount of people for short amount of time at very, very high interest rates. And there's still companies who do that. And this is clearly an area where you have to use your phone technology. I just dropped my phone. Okay, sorry, the phone technology, because, you know, if someone is going to borrow £10 for 2 days, you can't have them go to the branch or the bank for that. You need to be quick. And so the computer have to make decisions around that. They were quite good at doing that, Wonga. They did really well. But there were issues with Wonga around whether the algorithms that had been agreed with the regulator was indeed the algorithms that's being used. And so the issue was, as Wonga grew, that perhaps they were giving loans to people who they shouldn't have been giving loan to. And that the parameters that they have discussed with the regulator were not the parameters that they were using. So this was, if you like, an interesting case study, I know from the FCA, who I met and discussed this with, where it's just a new case, you understand? Because when you work with a bank, that's pretty clear, there's transparency, but this time, they were genuinely regulating an algorithm. And what happened, you know, if bits of the algorithms are changed and are changed in a way that perhaps the regulator isn't really happy with. So it really did change. The Wonga case really did change the thinking of the FCA and regulators around the world. So it's a very interesting case, and if you're interested, I recommend that you read more about it. I want to mention Funding Circle. So Funding Circle is a company that was started by two of our undergraduates in Oxford, and is now a public company. And I'm just being clear. I know I said Wonga and Funding Circle. These are completely different cases, and I'm not going to suggest any wrongdoing by anybody with this. But Funding Circle, if you like, there was an issue that so Funding Circle give loans to small to medium businesses, but the loans come from the public. So it's peer-to-peer lending. Okay, so and the key for peer-to-peer lending is that you have a two-sided market that you have to service at the same time. In other words, you have lots of people wanting to give money. You need to have lots of businesses that need loans. And you can't have one side like this and one side like this. And so Funding Circle started really strong. They still are doing really well. Certainly a great company. But you know, at some point it became very popular. And what you had is that there was more money, institutional money was coming in and so on, than companies to lend to. And so that create tensions that, you know, we didn't have before. So this idea of growth of two-sided markets, and how do you ensure that the algorithms only accept who they need to accept, and there isn't anything taken into account that shouldn't be taken into account. So these are certainly, from the point of view of the FCA and the European Union and governments around the world, this is new. This is new kind of problems. But from the point of view of algorithmic trading, this is not new, because algorithmic trading has been going on, as I said, from the 1980s, and a lot of experiences have been gained that I think are really relevant for what's going on here. I just want to mention briefly the history of algorithmic trading, because you know, I'm a member of the Mann Institute, and Brad kindly mentioned it in the beginning. So actually it's Mann AHL, and the reason I'm mentioning it is because AHL is the initials of three names of three statisticians from Cambridge who joined Mann in the 80s and wrote what was then one of the first black boxes, or what we now call algorithms, in the business. So it has been going for a long time, this idea of systematic trading and black boxes, and a lot of lessons have been learned from that around what I call here good algos and bad algos. I'm smiling because it reminds me of the Matrix. And if you remember, in one of the Matrix movie, the Oracle says to Neo, there are good programs and bad programs. And I think there's an element of that here as well. And I think we have learned this over the years of that. So what I would say, and this is something we cover a lot in the algorithmic trading course, if you're interested in that, I really recommend that you look at it a bit more. Good algos are algorithms who you know, take a set of rules and they execute that set of rules. So they take out, if you like, human judgment and human emotion. Sorry, not judgment, human emotions. That's the key. So they take out panic, and they ensure that your decisions are consistent and follow the set of rules that you have before. They clearly, good algos, you take advantage of the speed, so they can make decisions in lots of markets at the same time. And they could use all this to make decisions within good risk parameters. Okay. Whereas bad algorithms are the ones who move markets and cause all the problems that we talk about. So these are programs who kind of don't do what they're designed to do, and they take more risk than they should be taking. They leverage beyond the level of risk that they should do. And they're the one that blow up and cause all the problems. And I'll talk a little bit about them at the end when we talk about what just happened now, because if you like, the last few months have been a very, very good case studies in separating good algorithms from bad algorithms in what's going on now. So, lessons have been learned in algorithms, as I said, over the years, in terms of control. The big hedge funds have mechanism on ensuring that the algorithms do what they're supposed to do, that nobody manipulates the algorithms, that no one has access to the code, to the algorithms without agreeing it, for example, with the person controlling the risk in the organization. And that's, I think, a very good lesson for banks as well. So if banks are using programs that make decisions about, for example, credit scoring, and the parameters of those programs have been agreed with the risk controller of the bank, who are the people responsible from the regulator point of view, then no change to the algorithm can be made without them being enforced. And there are methods of doing that, for example, running multiple versions of the program, including a version of the program encrypted, can be run at the top at the risk manager. So the risk manager cannot see the code, or cannot, or the regulator cannot control the code, but it is a way, a verifiable way to see that no one changed the code. So these are tricks of the trade that's been going on, as I said, in hedge funds with algorithms for many, many years, that could really be adopted and used by regulators when thinking about algorithms making financial decisions in general. Okay, how am I doing on time? Good. So I want to talk a little bit more about algorithmic trading and how it's changed. The first thing I want to say is that algo trading it works. And if you're interested, I recommend this paper, and you can just Google it. It's called Man versus Machine. And this looks at data for between 96 and 2014, and tries to compare the performance of human traders versus systematic traders. And the interesting finding is that robots do better when we look at risk-adjusted return, not just returns, or risk-adjusted return, which is, in my view, what we should be looking at. And I think it sort of shows something about discipline and systematic approach to trading, because I think humans would always be tempted to have higher returns and not high risk-adjusted returns, which means you have higher returns, but you blow up faster as well. So there is some evidence, as I said, that this is working. So it's the only and most systematic and robust paper I have seen written on that. It's not easy to do because you have to compare all kinds of hedge funds returns, and they are not keen and sharing these things with you. But I would recommend that you look at that. I'm just very briefly going to talk about how things have changed, because I really want to leave some time for questions as well. How things have changed over the years with algorithmic trading. And it is a change of for two reasons. One is we have more data and more powerful computer, and we also have better models of dealing, of learning as well than what we had before. So this is an example of new sources of data. This is a satellite image of what a car park of a shopping center looks like. And basically you can use that data. You can buy that data now in a format that's very easy to write code that make decisions based on using satellite image of, for example, any chain of shops that you like. And you can deduce from that if the demand is up or down, and you can certainly decide from that if the share price should go up and down. So this is data you can buy now. So there is new companies, the name just escaped me, sorry, it'll come back, that are like Bloomberg for alternative financial data. So you can buy all that stuff. That's another one that you can buy, is the when the CEO is speaking to analysts, you can then, and there's a algo that in real time sees things like how many, the sentiment analysis gives you how many optimistic, negative, positive words he or she is using, and then you can use that to trade as well. centimeters. So you can buy that data and you can use it. So, I mean, people were doing that all the time before, but they had to do it manually or to write their own programs. We now have, as I said, a way of using that. So there's enormous amount of data that appears like that. At the same time, we have enormous progression in terms of what we can do with the data. So we have new models and new enormous computational power that allows us to analyze this in a way that we didn't have before. And I'll just give some examples here, and particularly the vision, because the vision stuff has been fantastic. And what you see on the right is what we call a deep neural network. And a deep neural network is, they used to be popular in the 90s because people thought that's a model of the brain. They're now popular because it's a good way of learning not just what this image is, but what the class of images is. So you can put all the people and all the cars and all the objects, and then the objects can have subcategories and so on. And then you can learn in lots and lots and lots of levels. And you have enormous amount of data. And I mean, you probably know it mostly from things like Google and Google Translate, where you have seen the enormous amount of progress, even in the last 5 or 6 years. And that's using models like this. So they're just using, because they have an enormous amount of data to train this with. And the rumor is that Google Translate have done its learning from documents of the EU, because apparently the EU, every document has to be translated to lots of different languages. And so that was the engine that they used to train the data on. And yeah, and they got enormous amount of information like that. So you have, as I said, you have the new data and you have the power to deal with it. You have these powerful computers and you have better algorithms for learning. And you put all that stuff together and you get fabulous stuff. And I'll show you one quick example of that before I finish, just to show you how things have changed. This is algorithmic trading in the olden days. And maybe some of you who are my age can remember it. And this is the charts where you looked at if it's above this, then you buy. You kind of looked at very simple graphics that you could code in Excel, or you can even see it with your eyes, and based on that, make a buy or sell decision. And I want to show you an example now of what the other extreme looked like today. And this is a paper that 3 of my colleagues in the Mann Institute wrote. And this looks at limit order books. So this does the same as this, but so still make a decision, you know, whether the market's going to go up and down, which is essentially what you're trying to do. So make a decision on that. But look what they do now. So they look at a limit order, and this is the actual offer price, but the price is determined by a process which is happen at every minute in time. And what you have is you have a bunch of people. This is what we call limit orders. So people saying, I'm willing to buy or sell at a particular price. And these limit orders then, and the sort of the middle price is between the buys and the sells is how the price is determined. So that's basically the price at every time. But what you see is that point that you've seen in time is really a model of what are the buys and the sells at a particular time. And when any sell that happen, it changes. So there is enormous amount of change at the micro level that we never ever looked before. This chart I showed you earlier that we used to trade is just a price chart. So we don't model, we don't think about the process where the price is generated. So there is a price, and it moves from one stage to another. But that's how it actually moves. That's how it's being formed by all these things. So you have limit order books. They keep changing and changing all the time. And that is how the price is made. Now, we didn't look at it because this is an enormous amount of data. Every fraction of a second, you have a huge list. So it was, you know, it was too much information. But now we have the computers and the ability to deal with that. And so what my colleagues and the Mann Institute did is they've modeled that. So they've had a statistical image of that, of every given point, and then they look at the dynamics of that, and they use something called thermodynamics, for example, Boltzmann equation and things like that, which is how we describe the movement of gases in a room and so on. And that can translate to some kind of picture, and that picture can be these algorithms, these neural network, deep neural network models. It's essentially what we're having here is the same as Google Translate, basically. And so we take this image and we kind of figure out what's going to happen next. This is not that different than what the self-driving car is doing when it sort of decides if something is going to jump into its way. It looks at the dynamics of the image that it has and decides from that what's going to happen next. And this is, as I said, Steve Roberts and Brian Zhang, and the paper that they've written, and they use all that information to make a decision. So, I mean, for someone like me who's been in this business for a long time, it's just mind-boggling the amount of information that's coming and how it's changed. So this is the kind of level we're talking about now. Better or worse, I don't know, but it's clearly is a lot more sophisticated, and that's what you need to be able to do now in order to analyze that. So yeah, you have to learn maths, I'm afraid, guys. Let me skip through this because I do want to talk about COVID now for a few minutes. I just want to say this is, you know, in algorithmic trading, clearly it's a very good idea to use AI for all the reasons I say here, but I'd like to emphasize my last points, which is you have to be careful about what I call the old enemy of overfitting. And this is really the issue we have with any kind of using the past to predict the future, is that you don't want to become too good at explaining the past. Yes, you want to become good at predicting the future, and maybe that's a kind of a good point to come to with what's happening with COVID, because clearly, you know, this is not something that happened before. It happened before in 1918 and before that, but it didn't happen in the lifespan of the algorithms and all the things that we're trying to train. So, so what? Is it good or is it bad? So let's first see what happened. So if we look at the algorithmic trading models, the systems, some of them did incredibly well. And mostly it was the trend type models. And why? Because the trend models thought stock markets are going to come down. And so they did. So they took that bet. And also the traders of volatility had a bet on volatility going up. And so people who got those bet rights did really, really well. Other firms did really, didn't do so well. So we're seeing interesting distinction in the market between the two. Is it insight? Is it luck? Is it good risk management? My view is that it's about risk management, really, because, you know, big waves come that you can't predict. There isn't going to be an element in the luck of luck always in whatever you do. And the trick is to have, you know, decent risk management that will separate you and that will allow that even if you get your bets wrong, that you have enough bets that are uncorrelated in different markets so that you can do okay. I want to talk a little bit about robos, and then I'm going to take questions. And the robos or robo advisors, I work a lot with these people, with some companies, because you could say that's sort of bringing trading to the masses or bringing asset management to the masses. So I think in general, it's a good thing. Interesting, they did well. So the group I work with are very big in the UK and in Italy. And, you know, people actually have increased their investment on these platforms. They haven't done badly. Some obviously they have been drawdown because most of them are long only, and so they have obviously lost some money. But, you know, if you look at risk adjustment returns, they didn't do really badly. And I think I think it's a good, in a weird way, good moment from that industry, because they have survived the first crisis, and it's actually the biggest crisis that we've seen for a long, long time. And this view that many people in the public had is, I don't trust a robot when, you know, it's okay when times are good, but when times are bad, no, I'd like to have a human in charge. I don't know if that's the case. And I think these robo-advisors, especially the ones that are responsible, have shown is that the combination of this, so that they use good risk management, they do have people that you can speak with at the end of the line, that these things do well. So I actually think it's overall good. The ones that did okay in this crisis are going to come up bigger and stronger from this thing, and people would learn to, you know, they will see that they've done okay during this kind of crisis, and they'll trust them even more. I talked a lot. All right, so I'm gonna look now at your questions.
Thanks, Nir. We have got quite a lot of questions. This is Claire. Do you want me to kind of read a couple out? And
yes, why don't you?
Okay, we've got one from Philip. It says, explainability is a huge area of concern for usage of AI and ML. Many regulators have since drawn guidelines on this. What is your thoughts on banks, financial institutions having to explain their proprietary algorithm and losing a competitive edge?
So, Philip, thank you very much. This is a really excellent question. So explainability does not mean that you have to reveal the actual details of what you do. And as I said, this is an area that I've seen in algorithmic trading a lot. You go to a hedge fund and you have an idea of a model. Maybe you work for that hedge fund. Maybe you came from university. Maybe you work for another fund. It doesn't matter. You have to talk to someone who is not necessarily an algorithm person and explain to them what they do. They're never going to give you their customer money just on the base of your statistics of performance. They would want you to explain what it does. And actually, if I'm on the other side and someone comes to me and he says, no, I can't tell you what it does, I don't like it. You can explain a lot without revealing the mathematical details. You can reveal a lot without, as I said, without that. And I think people should be doing that. And so there need to be a story, there need to be a reason. For example, Philip, I was saying, I use your customer feedback data to make decisions whether to give loan to that company, yes or no. Okay, this is an element of what I use your financial numbers in the same way the banks use, but I add to that, the consumer feedback. I've now explained to you what it does. I don't need to tell you the exact formula I use and what the weights I'm using in order to determine that. So I think there will be something around that. So that someone needs to be satisfied that they understand the general prediction of that and how is that changing, so that you can give. So another thing that's emerging around explainability is case studies. You can feed the algorithm a number of examples, and you want to see that the decisions are consistent with the explanation that they gave to you. If that makes sense? So everything is the same, but you have now changed one parameter. So this is now the regulator, if you like, or the risk manager feeding examples, pre-examples to the algorithm to ensure that the algorithm does what it's supposed to do and it doesn't do what it's not supposed to do. So there's lots of methods that are coming around that. And I think it is completely possible to get transparency, to avoid a lot of bad algorithms and simply cheating or overfitting, or algorithms that maybe cheating is a strong word. Obviously that's bad, but maybe also algorithms that just kind of overlearn the past and they're not really very useful for the future. I really can see methods of verification and explanation and explaining that come that you can get around a lot of that. But it's a very, very good question.
Okay, another one here, anonymously. Do you think widespread use of algorithmic trading increase weak form efficiency and make it harder for human traders to achieve significant risk-adjusted returns?
Oh, thank you for Mr. Anonymous or Mr. Anonymous for that question. So weak form efficiency. So first of all, I have to say this is a bit of an academic question. So this is the efficient market hypothesis and the idea that you cannot make money out of markets. And I think what this person is saying is that by trading, are we not, by taking advantage of these inefficiencies, are we not making the markets more efficient and therefore stopping the possibility of us making gains in the first place? So that's a very good question, and it's an old question, and there's a lot of papers have been written about it, and it depends. The answer is it depends. So if, for example, what you discovered is that markets always open higher on Monday than they close on Friday, and you trade on that, then by you trading on that, you close that opportunity. So that specific arbitrage opportunity, by trading, you are making the markets more efficient, and therefore it disappears. So if that's your trading strategy, you can make money for a couple of months and then you'll stop because you have corrected it and other people would learn it. But there are other forms of systematic that would not go away. So I've mentioned in the slides that you can see momentum. They're always going to be momentum. Okay. In fact, even the hardcore efficient market hypothesis people, even the Nobel Prize winners will admit now that momentum or trend is part of that. That's human nature. That's the fact that it takes us a while to process the information, and especially for all those pension funds and all those hedge funds. And so when markets go up, they go up for a little bit longer before they do that. And when they go down, so we see waves in this market, and taking advantage of these waves, trading based on them, isn't going to make them go away. In fact, mathematically speaking, if anything, it's going to make them a little bit stronger, but it doesn't really impact them very much. So I think, from my experience in the market, it's very difficult to consistently make money. Don't get me wrong. I don't think I'm not one of those people who are going to say to you, oh, come to my course and you make loads of money. That's not like that. It's hard to predict the future. It's hard to make money, but there are irregularities, inefficiency in the market that come from psychology of the masses, if you like, something like that. And that's never going to go away. I mean, you can see now, well, look at the state the world is in now. You can see, at the top levels, good politicians, bad politicians, good governments, bad governments, they all did the same. So, this idea of aggregated hysteria or panic always is going to be an element of that in the markets. And I think algorithms that are designed to trade based on these things are always going to have some kind of luck to use these things. So I hope that answered the question.
Thanks, Nir. Another one here from Alexander. He says, any new developments that are just on the horizon that excite you? Far out stuff?
I mean, it's all very, very exciting. I mean, look, the digital footprint is the big thing. I mean, the fact that we have all this enormous data is both scary, because to be honest, the more you learn about these things, the less you want to use your phone. But so that creates an opportunity. So I'm actually more. I think the more opportunities are around what I call the new sources of data, rather than necessarily the way to analyze them, because all these algorithms are better and faster and great, and I think you should learn about them. But I don't know if they have really changed the quality of predictions so much. It is really the new data that's available there. And let me maybe say something more general. If you think what finance is about, in general, as a profession, it's really about risk. It's about managing risk, measuring risk, responding to risk. This is really what banks, what traders, what hedge fund managers, what investment managers, this is kind of what our life is. And if, and risk is not knowing. Yeah, sorry. Risk is our mathematical way of saying, I don't know something, so I'm going to give it a bunch of numbers instead. But if these devices, if these new lens of information can be used to reduce the risk, to make better predictions, so this comes to the core of what finance is. So I do think things can change, and where you really would see big dramatic changes would be in the areas that are just about that risk. For example, insurance. the whole point about insurance, how I learned it in university, and most of you have learned it, is this idea that the insurer knows less than the insuree the level of risk, and all the models and the pricing comes for that. But that might change. You know, if I'm wearing now whatever device that what do they call Vitali, the South African insurance company, give me to wear, and basically measures my my health, my various health measurement all the time, and sends this. It fundamentally changes the asymmetry of information behind how these markets work. And so I suspect that insurance markets is where we're really going to see very, very, very different kind of contracts, very kind of different economic models and so on. So yeah, there will be areas that will be changing. And, you know, I think that's exciting because, you know, these whole areas were invented in the first place to accommodate the kind of level of uncertainty that we had. If we can reduce that, make it better measure it, it can happen. So this is the bit that I think I'm excited about. So yeah, I think InsurTech, as they call it, I think that's a really interesting one.
Yeah, you've got loads of questions, and I'm probably not picking out the best ones, but I'll pick out another.
Yeah, good.
And
Thank
then
you,
I
Claire.
don't know if you might want to close off, but one from Giancarlo. Given the higher risk adjusted returns of algos, is asset management destiny written already? Is human intelligence actually becoming a problem to manage, bias more than a value to explore? Is there space for human power that can be instead empowered by AI? And he goes on.
Yeah, but this is a very, very good question. And so, look, if you look at wealth management, let's separate maybe the hedge fund from wealth management to the masses. So hedge funds are the high end. They take only very large sums of money. They're less regulated. They can do more stuff. It is true, the percentage of algos there is increasing and increasing, and I think that trend will continue. However, I have to admit, there are some amazing individuals with great intuitions, some of these legendary traders, and you can read about them, are consistently performing year in, year out. So I think overall, the computers are better than the average person, but the exceptional persons are still good. And actually, those exceptional persons probably do use models. So they have kind of in the back of their mind some kind of their own models for how they do that. So I think we will see more algos, but it doesn't necessarily go away. Where it really will have an impact is on wealth management of people with small amount of money. And this is what we call the robos, because these people were essentially excluded. They were getting bad service because the banks didn't really spend much time with them. They didn't take advantage of their possible tax allowances and so on. And so this is, I think, where robots, simply by reducing the cost, will open up that market and would make it better. Thank you very much, everyone, for the question. I wish I had more time, but I think I'm going to hand over now to Brad, who's going to talk more about this program. But if you're interested in finding out more, I'm very happy for you to LinkedIn with me or to email me, and I normally try and reply to these things as much as I can. And I hope you have enjoyed the presentation. Thank you. And Brad, over to you. I'm going to stop sharing, Brad, so you can take over.
Great, thank you, Nir. Claire, would you like to share the slide deck for the next part of the presentation? Thank you. Well, firstly, I just wanted to say thank you so much to everyone in Nir for your time on today's presentation. I hope you've appreciated Nir imparting his knowledge, experience, and wisdom over many decades working and researching in this area. Thank you, Claire. So my name is Brad Pearson. I co-lead our online executive education portfolio at the school. And as and Nir touched upon earlier, we have a number of different executive education programs, which speak to today's topic. Next slide, please. Okay. Next slide, please.
Can you see my slides okay?
Yes, that's perfect. So just to go into a little bit more detail and context, Saïd Business School collectively is growing, well, has a reputation in the broader of digital finance. We look at a number of different verticals within that broader area. So as Nir has shared his research expertise with us today, the business school takes the areas of fintech, open banking, and the future of real estate, so PropTech and real estate innovation, very seriously. We've got dedicated research functions in a number of these areas, and we have collaboration with the likes of the Oxford Mann Institute across the greater university. Our alumni, interestingly enough, on the slide you can see a number of interesting, well-known companies. A lot of these organizations, specifically Seeders, Funding Circle, Onfido, were spun out and started by our alumni. A lot of the ideas and the concepts were thought of during either our students' undergraduate or MBA study, and a number of these concepts have blossomed into very successful organizations today. Next slide, please. So just to give you some context, our online executive education portfolio started in October 2017. We launched our first financial technology program then, which Nir directs. And as a result, we've been growing our portfolio out to speak to different, I guess, a number of historical areas of research and teaching expertise that both the school and university are renowned for. And here is a short, quick illustration of the different types of programs we offer in our portfolio. Over the last 3 years, our community has grown to 14,000 strong from 167 countries. Our professionals are typically middle management all the way up to the board, but we also do have a number that are functional professionals and experts in their own areas. The types of professionals we tend to attract, the average participant demographic aggregates out at 40 years of age. So our participants tend to have master's degrees, some have MBAs, MScs, and PhDs as well, with 15 plus years of experience. So we convene an experienced and senior cohort, but obviously the nature of online executive education, we have a number of upcoming ambitious professionals that join us across the portfolio. Next slide, please. So what does an online program look like? Typically, they are 6 to 8 weeks in length. The average time is 7 to 10 hours of effort per week. So it is an investment of time. It's a high-touch experience. So we offer 3 different layers of support. We have tutors and academic facilitators that work with individuals to ensure they understand the material. We also have success managers to work closely with each participant to ensure that they attempt to meet a work-life balance. So if a last-minute work assignment or a family emergency crops up, our success managers work very closely on a per participant level to ensure our participants are able to complete the program. This has enabled us to achieve a 93 to 95% successful completion rate, which is one of the highest in the world. we believe our portfolio is focused on online executive education as opposed to lower cost, massive open online courses, and that is reflected in both the high touch experience and the price point, as both the school and university have invested significantly in these programs, and they are very much an online version of our on-campus executive education portfolio. Next slide, please. This slide quickly illustrates that we offer a number of organizational benefits. So our portfolio is not just for individuals, it is for organizations as well. And we've had a number of organizations that have invested in sending teams and divisions onto our programs, and I'll discuss some of the options in the next slide. Next slide, please. Okay, Claire, is there another slide in the deck? That's okay. So we offer organizations three types of options. If an organization is looking to buy an online program specifically for their organization, so say if they wanted to take our algorithmic trading or fintech program and make it exclusively to their organization, we do offer a co-branded standalone version, so white label for organizations. And I will be happy to talk through some of those options with you. So typically we would look for a minimum of 100 participants to make that option viable, but that gives an organization a flexibility to contextualize a universal application of the program and make it more tailored and specific to their specific sectoral context. So we do offer that option, and there are numerous number of benefits that come with that option, and I would be happy to share that post today's webinar. We also offer private classes within an existing program. So if an organization are able to invest in up to 50 staff, what we are able to do is offer the best of custom and open executive education, where you will have a dedicated academic facilitator who will help contextualize some of the material back into your specific organizational and sectoral context. And we provide co-branded certificates, but we also provide performance reporting. This option gives organizations the ability to halve off confidential information from the rest of the participants on the platform, which enables them to execute upon strategic, confidential organizational strategies and objectives. So we are able to marry those two together, so the organization gets to retain the diversity in terms of interacting with other participants from different organizations and geographies around the world, while specifically working as a group through the learning journey. And then our final option is we enable organizations a number of organizational partner rates. So if they wish to buy, say, 30 places across the entire portfolio, we are able to work with you to achieve that, to make to achieve the economies of scale through our organizational partner rates. This also gives an organization's HR and L&D teams the flexibility of allocating professionals to different presentation options running throughout the year. So we build in a level of flexibility which helps organizations send professionals or employees onto our portfolio at a time that suits both them as an organization and their respective employees' diaries as well. So I think that's it. I've gone 4 minutes over, but I just wanted to say thank you so much for taking the time to join us for today's webinar. We really appreciate it. We appreciate all your time, and thank you so much to Nir for giving up part of his day to share his knowledge, wisdom, and experience with with today's attendees. So thank you very much. If you would like to contact us with regards to any of the offerings, my details are on the slide. Thank you.
Thank you. Goodbye, everyone. Thank you.
Thank you.